While you're watching this video, inflation is doing something to your savings account. Not dramatically, not in a way you'll notice today, but it's happening right now while you sit here. Last year, Americans held $18 trillion in savings accounts and money market funds. $18 trillion. Quietly losing purchasing power every single day. And here's the part most people miss. When money loses value, wealth doesn't disappear. It moves. Not randomly, not once in a while, predictably, into the same types of assets again and again. The people who understood this didn't panic. They didn't sell everything. They simply moved their money into a different category of asset. 6 categories specifically, the same 6 that have absorbed wealth during every major currency crisis in recorded history. Not crypto, not stocks, not anything complicated. Things that existed long before central banks did. Things people reached for when paper money stopped working. And the last one on this list requires zero starting capital. It cannot be printed, it cannot be confiscated, and you probably already have it. You're just not thinking about it the right way. This isn't ancient history. This isn't a story about somewhere far away. Since 1913, the US dollar has lost more than 96% of its purchasing power. Not in theory, in real goods. And the pattern of what survives and what doesn't has been the same for 4,000 years. The first asset that survives every crisis is land. Not land as a number on a balance sheet. Productive land. Land that grows food. Land that holds minerals. Land that sits on water. Because when money fails, the economy doesn't stop. People still eat. They still burn fuel. They still need raw materials. And whoever controls the source of those things controls real power. In Weimar Germany, farmers who owned their land outright became the new elite almost overnight. Not politicians, not bankers, farmers. A pig farmer could trade a single hog for a grand piano that once cost a banker 3 months of salary. That's not an exaggeration. It's documented history. Before I continue, I want you to think about something while you watch this. Look at what you hold right now. A savings account, bonds, a retirement fund. If money stopped working tomorrow, which of those things would still have value? Keep that question in mind. By the end of this video, you'll have an answer. The second asset is gold. And this isn't about ideology. It's about how people behave under pressure. When a currency fails, society doesn't wait for economists to design a replacement. People reach for whatever already works as money. And for thousands of years, that fallback has been gold. Not because it's magical, because it's recognizable, because it's portable, because it's difficult to counterfeit, because it cannot be printed overnight. During the French Revolution, the government issued paper currency called assignats. At first, people trusted them. Then the government printed more and more and more. Within 5 years, those notes had lost more than 99% of their value. People who converted their savings into gold early preserved their wealth. People who waited lost it. Argentina, Russia, Venezuela, different governments, different cultures, the same human reaction. Gold doesn't make you rich during stable times. It keeps you solvent when everyone else is broke. And here's a detail most people overlook. Central banks, the very institutions that create paper money, have been accumulating gold at the fastest pace in decades. They prepare for scenarios they publicly dismiss. The third asset is a business with pricing power. Not every business survives inflation. Most don't. There's a specific type that does. Companies that sell things people cannot stop buying. Food, fuel, medicine, electricity. If you sell luxury goods, demand disappears during a crisis. But if you sell cooking oil, demand doesn't drop. It can't. And that changes everything. During Brazil's inflation crisis in the 1980s, prices were rising so fast that supermarkets changed price tags several times a day. Morning prices were outdated by the afternoon. Companies that could raise prices immediately stayed profitable. Companies locked into long-term contracts were wiped out. Same economy, same inflation, different outcome. The difference was speed. In every inflationary system, purchasing power flows toward the businesses that can raise prices faster than the currency loses value. Not the smartest businesses, the fastest ones. The fourth asset is foreign currency. More precisely, assets denominated in someone else's stable money. This is the line that separates those who survive a currency crisis from those who don't. During Latin America's debt crisis in the 1980s, the pattern was almost mechanical. Wealthy families held dollar accounts abroad, real estate in foreign cities, savings in hard currencies. Their wealth remained intact. Middle-class families held savings in local currency. Their wealth disappeared, not slowly, almost overnight, Because when your money is denominated in a failing currency, your wealth fails with it. When it's denominated in something stable, you watch the crisis from the outside. And when governments begin restricting withdrawals or limiting transfers abroad, that's usually not the beginning of the crisis. It's the middle. The exits are already crowded. The fifth asset is real estate, but not for the reason most people think. Real estate doesn't protect you because prices rise on a screen. It protects you because buildings are physical objects. You can't print an apartment building. You can't inflate away concrete, steel, labor. In Weimar Germany, apartment prices rose into the billions of marks, numbers that looked like wealth. But the real protection wasn't the price. It was the structure. When the old currency collapsed and a new one replaced it, those buildings were still standing, still collecting rent, still holding value. Meanwhile, people who held cash savings walked away with nothing. Real estate survives currency collapse for the same reason land survives. It exists outside the monetary system. You can change the money. You can't change the fact that people need a place to live. Before I name the sixth asset, remember the question I asked earlier. Look at what you hold right now: a savings account, government bonds, a pension with fixed payments. Do you notice what they have in common? All of them are denominated in currency. All of them assume money will continue to function. And in stable times, that's a reasonable assumption. History shows that stable times are the exception. Now the sixth asset, the one I promised at the beginning. In every major currency crisis, there is a group of people who continue functioning economically while everyone else struggles. Not because of what they own, because of what they can do. Doctors, electricians, mechanics, engineers, anyone whose work solves immediate problems. During Hungary's hyperinflation in 1946, the most extreme ever recorded, prices were doubling every 15 hours. 15 hours. Government employees on fixed salaries were wiped out, but skilled workers adjusted their prices daily. They kept eating, because when money breaks, the economy moves closer to barter. And in a barter system, practical skill becomes currency. Skills are the only asset that requires no starting capital, cannot be confiscated, cannot be printed, and cannot be inflated away. And yet they are the one asset most people ignore when thinking about financial protection. Now put the pattern together. Across 4,000 years of financial history, from ancient empires debasing coins to modern economies printing money, the same six categories consistently absorb the wealth that leaves collapsing currencies: productive land, gold, businesses with pricing power, foreign currency, real estate, essential skills. And the assets that fail are just as consistent: savings accounts, government bonds, fixed pensions, long-term contracts, anything denominated in a failing currency. These assets feel safe, right up until the moment they aren't. Here's the reality history keeps delivering, again and again. Monetary stability is not the default state of civilization. It's the exception. Most currencies don't last forever. They erode, they devalue, or they collapse. Sometimes slowly, sometimes suddenly, but always predictably, not in timing, in outcome. No one knows when the next crisis will happen. No one can predict the trigger, but the pattern of what survives has already been tested for centuries. The question isn't whether a crisis is coming. The question is simpler: look at what you hold right now, and ask yourself, if money stopped working tomorrow, would your assets still have value? Because when the next crisis arrives, and history shows there is always another one, it won't matter what you studied. It won't matter what you believed. It won't matter what you predicted. It will only matter what you held. If this changed how you think about wealth, write in the comments the one asset from this list that you actually own today. Not the one you want to own, the one you have right now. In the next video, I'll break down what happens to each of these six assets during a US technical default, step by step, day by day. Subscribe so you don't miss it.